Hello everyone, how's it going? In this video, we're going to talk about SOFI Technologies, trading under the ticker symbol SOFI on the Nasdaq. So, as one of the most volatile and bullish stocks during the peak of 2020 and 2021, SOFI has definitely been on many people's radar, or at least at the back of their mind. As one of the more developed fintech enterprises out there, SOFI accomplished something that many fintech either couldn't or didn't want to bother. They got a bank license. With that key document at hand, SOFI stands as one of the most fleshed out and comprehensive fintech companies out there. With that being said, the recent stock performance of SOFI has followed the market trend overall down. Nevertheless, many people are still interested by eventually buying SOFI because it seems to have a lot of potentials. So in today's video, we will take a look at SOFI and to try to work out if you should be buying its shares. Before we start, I'd just like to state a brief disclaimer. My videos cover my opinions on the current events and what's likely going to happen. They're not investment advice and should be watched for entertainment purposes. No one can predict the future with 100% certainty, so everything that we say is just our best guesses of what might happen based on what we already know. My videos are prepared either immediately before the uploading or a few days before they were released. Some of them may no longer correspond to the latest price actions, but nevertheless, they would still be relevant to analyze the subsequent price tendencies and to improve the decision making. Also, the videos aim to cover the securities as broadly as possible by covering the fundamentals and the technical aspects. Other than the price actions and the latest news events, the long-term tendencies, shareholder composition, and fundamentals will also be covered. They all affect the decisions about if we should buy a security, how many should we buy, and whether it should be bought at the current price. With all that being said, let's get into today's topic. SOFI is a fintech company aiming to become a virtual bank for users seeking more functions, flexibility, and competitive fees. As people's needs change over time regarding how and where they have to access their money, SOFI has identified the opportunity to do better than traditional banks, offering a scalable, consistent, and good quality service for its users and clients. Unlike many fintech companies who offer different parts of what a bank can offer as functions, it's worth pointing out that SOFI tries to bring all the services under one umbrella in order to optimize the acquisition cost for each product and improve cross-selling. The company excels in areas of loan refinancing, personal banking, and wealth management. It recently got under some selling pressure due to the student loan moratoriums, and with that went most of their gains throughout the bullish period. However, it should be mentioned that despite the challenging environment of the economies around the world, it's not just bad news for companies like SOFI. People are now more aware of the financial fees from traditional banks, and many are looking for alternatives given that the recession forces them to cut spendings. SOFI might be one of the companies that can satisfy this need for better fees. This might be one of the reasons why, despite having a challenging investing environment, SOFI still manages to see its customer deposits increasing during this year. Another factor to consider is the ongoing quantitative tightening and inflation. When inflation is high due to the external reasons, interest rates also go up, increasing the profits and the yields of different asset classes. After all, the purpose of a bank is to make money with the deposits, and the current environment allows SOFI to do just that. Overall, SOFI has been growing on a year-to-year basis, although the progress has been slowed down in the recent month. This might be caused by the economic downturn, which puts pressure on all businesses. Despite the unfavorable headwind, the fact that they still manage to grow at all is a testament of their brand power and the attraction that they have on potential customers. Due to regulatory and economic reasons, SOFI saw its student loan and home loan amounts decreasing by 51% and 73%. But this has been compensated by the fact that personal loans increased by 71%. resulting in an overall increase of lending on a year-to-year basis. Over the past few days, the stock price of SoFi has been, staging a very gradual recovery from the sell-off that was approaching $4 and ended up with a 0% volatility over the past 5 days, which is very noticeable for, at least for me, given how much sell-off pressure there was over the past few days, or weeks rather, due to worries about the state of the economy and the pending recession that is expected to occur in 2023. The market has since then stabilized and is currently looking for catalysts to justify more recoveries. The long-term stock performance of SoFi has been like every other major growth stocks listed on a Nasdaq for the entire year of 2022, meaning it has been disappointing for sure. The stock has been down by 70% since the beginning of the year, which is mainly caused by the moratorium of student loan, a major branch of lending business. So the information that is available on the subject suggests that those moratoriums are going to end by January of 2023, meaning there will be additional needs for student loan related refinancing in the year to come. With that being said, it's worth mentioning that personal loan has already filled the gap left by the student loan and home loan combined, which does compensate the loss. What also brings down SoFi stock price and arguably keeps it down is the fact that it's a small boat in an ocean of bearishness. The Nasdaq, much like other major indexes around the world, have now lost most of the gains made during the period covering 2020 and 2022. This suggests that the market has now come back to the predictions by the end of 2019 regarding the world economy, meaning they were already anticipating upcoming recessions, but without the worries of inflation and armed conflicts. This is why I think that the probability of entering in a recession in 2023 and beyond is probable or very high, which would bring the valuation of many securities down. So basically, what lies ahead for SoFi is the possibility of a partial recovery of their student loan business, but also a market-wide pressure due to the economic weaknesses. With that being said, because SoFi fell so much, more than like the rest of the sector, or the market rather, the sector, if you want to say that PaySafe is any better, I'm not sure I would believe you. I don't think that its share price is going to fall by that much more, given the current region is between $4 to $6. So I think that it's going to hover in that region when times are bad. Now, let's also take a look at the company's financials and see what the numbers tells us. Regarding the profitability, SoFi is currently incurring a net loss from its operations if we include the non-cash transactions and the non-operating expenses, mostly interest expense and equipment amortization. On the other hand, SoFi is yielding positive gross profit that grows across the past quarters, which is something that encourages us and show the validity as well as the scalability of its business model. The one challenge that SoFi would address is the cost control, especially when it comes to operating cost. I think that the spendings are going to be under control eventually, but for now, I think that SoFi will probably favor growth over cost control. Another aspect that is important is leverage. Of course, being a fintech company, SoFi has a high degree of leverage accumulated over the quarters. This is relatively normal given the industry that SoFi operates in. Nevertheless, we should be aware that the current level of debt may cause some issues down the road, which is already showing given that the equity of SoFi has been reducing over the past 3 quarters, which is a sign that the funds borrowed might not have been used at the maximum efficiency. When we take a look at the company's ratios, it's not difficult to see that, in terms of valuations, it's going slowly down over time. This means that the company is not growing as fast as it should be, which is normal given the current market conditions. Nevertheless, we got to be aware to the fact that SoFi is losing value on paper, and we should see whether the situation can rectify itself in 2023. Regarding the company's profitability ratios, what the numbers tell us is that things are being stabilized, and from some perspectives, even going above the break-even line. In that sense, it is definitely an improvement over time, and we should see whether SoFi can control its costs in the years to come. And for now, the gross margin as well as the EBITDA are what matters the most. And both of them, I think, are positive. So, regarding the shareholder composition, what this tells us is that the stock is more molded for trading or investment, and as well as the volatility of the shares. SoFi is owned by institutions for up to like 36% of the current float, which is significant but shows that a majority remains retail, meaning their shares are going to be volatile on a relative basis, and also they tend to trade in and out depending on rumors or very small pieces of news. With that being said, with 36%, I think that we can invest into SoFi. This is a viable option. We should also point out that around 38% of the stock is owned by insiders, which offers, to me, like an additional layer of reassurance. So regarding the shorts, there's currently about 12% of their volume being shorted. This is significant, but it's not enough to say that the main reason is that we're hoping for a short squeeze. So if anything, I would say that it's definitely something that we can put on the table for as a secondary reason. A lot of people are hoping that the times are going to get rougher, but what if $4 is like the bottom? Okay, so this is something to consider as well when you want to buy SoFi. So given all this, I think that considering the current market environment and the price actions, it's going to be a decent choice to start buying with some anticipation that we're going to still see that we're going to have like some way to go before reaching to the former glories of SoFi back in 2021 and 2022. That being said, it's a decent stock to hold for the long term. My recommendation for exposure is between 3 to 5% of the portfolio.